Good afternoon, everyone. Welcome to another one of Avant-Garde's free educational trading webinars. We are thrilled to have you with us today as we welcome back Vlad Karpel to another installment of Lunchtime Options Trading. We're thrilled to have Vlad back, and I believe we have Keith Harwood here as well to help with some commentary. We're going to talk today about how to improve your trading position entries and exits, look at the current trend, and try to predict the highs and lows to get those trades in. So we're thrilled to have you all. Thank you for everyone who has attended live this afternoon. I encourage you all to please ask questions during Vlad's presentation and at the end. If we don't get to them during the presentation, we'll circle back at the end and Vlad can address those. So we encourage everyone to do that and be involved. Vlad, are you with us?
Yes. Can you guys hear me?
Yes, we can. Wonderful. Thank you so much. Keith, I know you're here as well, but we're going to go ahead and let Vlad take the wheel and drive this car as we start the webinar. So Vlad, when you're ready, you can go ahead and pull up your presentation and take over the screen share.
Let's try.
And I'll just remind, go ahead. And I'll remind everyone with us live to put those questions in the chat box as they come to you, and we will we'll get those over to Vlad or Keith to address. Okay, yes, can see your screen now, Vlad.
You guys can hear me, right?
Yes, sir. You can start when you're ready.
Sounds good. All right, again, thank you very much, Natalie and AGT, for allowing me to do the webinar and kind of continuing our discussion from last week on optimizing your entry point, looking at the different setups and how to find support resistance, trend analysis, and how to generate potential successful strategies for, and I purposely put weekly, kind of a short-term trading, right? Talking about 0-day still expiration options or weekly options. They've been very popular and growing exponentially year to year. Before we start, encouraged to ask questions, everybody. This is my brief bio. I was Executive Vice President and Head of Technology at Options Express from 1999 through 2000. My background is building technology, building AI, using neural networks to learn on market data and make predictions for different time intervals. We're going to talk about weekly time intervals, but whether it's weekly or monthly or daily predictions. So my background is in technology. I've been doing that over 25 years. When Options Express went public, decided to manage and trading my own money. I've been doing that for over 25 years. So that's my background. And Keith, you want to jump in? And I know you're adding a lot of value from the, trading perspective, market maker perspective. So maybe you can...
Yeah, so a little different from Vlad. I started 20 years ago as a market maker on the CBOE floor, and I've worked with hedge funds and market making firms and prop trading firms, and now in the educational space, applying a lot of the options knowledge and things to my trading focus as well as the technicals. But certainly Vlad's got a big leg up on me in terms of the artificial intelligence knowledge and the programming and things of that nature.
Perfect. Thank you. I'm going to go through some trade ideas, trade examples, right? So it's important to understand the risk associated with trading stock or options. If this is the first broadcast, or if you have never seen this slide before, I encourage you to visit optionstrading.com so you can understand the risk and suitability associated with trading stock or options. I'm not a financial advisor, and I'm here to show you what I do in my own account based on my own risk tolerance level for general education purposes only. So important slide. Again, just quick recap from the last time. I like doing different strategies, right? Whether it's taking advantage of earnings because the implied volatility is higher, or taking advantage of the Fed decision on interest rates yesterday when the volatility increases. A lot of people do short-term trading, right? You're looking for 0.5%, 1% move in underlying stock, right? If you trade in S&P 500 stocks, some are higher beta, but for spiders, for the most part, when VIX is under 20, you're looking for small time price fluctuation. It's a repeatable process right? There's almost every day there's earnings. There's every day stock market is trading in a certain range, right? And as a trader, your goal is to understand the trading cycle, right? And to find these support and resistance levels and direction so you can optimize your trading plan, right? So we're going to look at that together. We're also going to look, the goal is to optimize the position entry and exit, but also design proper strategies based on probability of success. And we talked at length with Keith about this. Trading is, and I covered that, I think, 2 weeks ago. Trading is all about position size, but also setting up your trade where return on capital and probability of success makes sense, right? You could look for high return on capital, small probability of success trades. You can look for, low return on capital, high probability of success. It's going to be very hard to find, trades where you have very high probability of success and very high return on capital, right? That usually does not exist for retail investors, right? So here I'm looking at the different ways to look at the price forecast. I alluded that my background is artificial intelligence and learning on historical data, right? Look for patterns, right? And then based on machine learning and AI, they can make predictions, basically saying, this is where spiders gonna trade in a certain time interval. So kind of a more of a traditional analysis. So let's look at both. One is looking at the AI models or just the technical analysis. So I'm going to look at spiders first. Spiders, and we can go and look at different strategies, all right, for puts and calls. So traditionally, you have models based on moving averages, right? Exponential moving averages, RSI. We talked about some chart patterns last time, like ascending, descending triangles, flag formations. And you have ability to basically look at different stocks, spiders, you can put Microsoft, Nvidia, and look at some kind of technical indicators, right? Technical indicators, right? This is just simple, example of exponential moving averages, RSI, and basically showing that the spiders, the short term, it's still an uptrend, medium term, the stock market is an uptrend after the Fed decision, and we're breaking out to new all-time highs, right? And long term is also maximum, haven't seen. So kind of showing you that based on these models and these signals, that the spiders are overbought. So this is historical data, right? Looking at the historical volatility, backward looking. This is not AI model. This is just an example of rating system, right? That can tell you, that the spiders are trading in uptrend. Then the question becomes, well, what about, where the support and resistance for spider shows up? So now I'm looking at the gamma exposure data, kind of mentioned it last time, but let's say I want to know what will happen between now and next Friday, right? Or between now and tomorrow. Today is Thursday. Let's look at, tomorrow's monthly expiration. So you can expect more volatility. A lot of the contracts will expire. So if I look at the September 19, and now I'm looking at the supply and demand for options data, right? Basically till tomorrow. If I want to trade options that expire tomorrow, right? What would be the optimal entry point? What would be the optimal exit point? So you can see based on estimated move for September, market implies 0.6% move to the upside or to the downside, right? So you know that expected move between now and Friday is less than 1%. 60 basis points, 70 basis points. Now, where are the key support and resistance levels are, right? Then I'm looking at these bars. This is concentration of high open interest, right? Where the high open interest is concentrated. So you can see right now we're trading close to 665, right? So this is probably a little delayed, but right now we're at 663. So we're making new highs, right? And people are already positioning by buying puts and calls. In this example, that will expire tomorrow. So I know that as we approach in 665, this is where the highest concentration of calls right now. This is an overhead resistance, right? And market may or may not break through the 665. So this is your first resistance level. And if we do break through the 665, then your next level of resistance is 670, right? So I can see that the short-term trend is to the upside, medium-term trend to the upside, assuming there is no events right, like Fed decision or escalation in tariffs, that this is your resistance levels, right? So 665 is your resistance number one, 670 is the resistance number two. And on the downside, support is we broke out through 660 yesterday. We closed above 660 several times, and now we're still trading above 660. So this is your major support. So if you know your support and resistance levels, then you can structure your trade, especially with the positive bias, that if we do pull back up to 660, I mean, today I think the low was around 660, then this is a buy zone, right? If we jump to 665, 670, this is potentially is where you want to maybe trim your positions because you're facing overhead resistance, right? If you're trading short-term options, or if you just trying to optimize your entry point, right? At 660, maybe this makes sense to buy or add to your long position. At 665, it makes sense to maybe trim or exit some of your long positions or going short. So this is basically one way, well, two ways, right? One is historical data, looking at chart patterns we talked about yesterday, looking at ascending, descending triangles, looking at the supply and demand for stock data, looking just the regular chart analysis. For trend to know the direction, you can look at different models. I showed you an example of bar chart models that does show you that medium term, short term, long term, we're still trading in uptrend. And then when you trade, based on yesterday's discussion, we were talking about if you are, let's say your time horizon is Friday, right? You want to open and close position tomorrow using 0-day still expiration options. Then I would look at 1 hour chart candlestick and maybe 1 day chart candlestick, where each bar on the chart is either 1 hour or 1 day. So you can basically superimpose what you see on this chart versus if I look at just the regular chart analysis. And maybe look at let's do 1 hour, since we talked about. So each candlestick is 1 hour. So you can see, based on traditional technical analysis, yes, you can see high concentration at 665, right? This was the high from this morning, right? And then the low is 660, right? And that accidentally almost to the penny matches the supply and demand for these option contracts. So we're at 664, 665. This is probably time to trim your long positions. If we revisit 660 like we did this morning, okay, then this is the time to potentially enter position. And yesterday, even with the binary event, like a Fed decision on interest rates, right? Fed basically said that, okay, we're going to cut by 25 basis points. There's 2 more rate cuts penciled in, for this year, 3 more rate cuts next year. But, we're data driven. We're going to look at the unemployment data. Today, initial unemployment data came in better than expected. Market rally. If it was worse than expected, market would probably sell off. But you can see yesterday's low was coincidentally exactly at 655 level. Especially if you look at the SPX, it was exactly at 6,500, right? And today, same thing. You have 665 is your overhead resistance, and now 660 is your support. And this is where it gives you kind of clues of where you want to structure your trade. There's also a flip point, right? We talked about flip point last week. I'm going to reiterate. I think it's a very important information that basically says, right, going back to game theory, you want to know not only what you trade in and what your opinion on the market, but what are other people thinking. And right now, the flip point is 655. So as long as stock market is above 655 level, that means that the dealers are forced to be gamma and delta neutral, and they will step in and they will provide support for the market. That's this green line. So as long as there is no, and the vice versa, if we drop below 655, 650, then the sell-off could accelerate to the downside for the same reason, because the dealers are now negative gamma and they want to be neutral. Any questions? Let me see if there's any questions so far. Keith, anything to add on 0-day still expiration options, support resistance levels?
No, I think you kind of keyed in. I mean, the open interest and the volume generally create big levels that we just have to monitor closely when going through it. And yeah, I think that's the biggest thing for me.
Great. So the reason I like these short-term option trades, or it could be stock trades, but for the most part, we're talking about options. Or we have FedEx earnings today, right? It's the same thing. It's an event, binary event. I call it binary event because you're gonna have a move. Just like yesterday after the Fed decision, you know that the market will move, right? Either break out to the upside or break down to the downside. But you can take advantage of volatility, time decay, right? And this is the best way to learn how to trade options, right? Because if you're doing kind of a long-term trading, you're buying a spread and you're looking for 45, 50 days till expiration, kind of a traditional trading, how I learned trading. I didn't learn trading on 0 days till expiration options. They weren't there. But we would learn on kind of regular concept. Look at the options, 50 days till expiration, be conservative, try a spread. But then you have to wait 30 to 40 days to learn about time decay, learn about delta. When you're doing these short-term trades, especially I'm going to go to make sure that you understand the risk involved, right? You can quickly learn about trading. So even though I'm not a big I personally don't like to do day trading where I think about, a couple minutes or 15 minutes or an hour, but I do like to think about what's going to happen, between now and Friday, right? In terms of the estimated move, the range where the stock could be trading versus, is the implied volatility is the enough for me to take the risk and be either long or short the volatility. Do I buy options? Do I buy the calls or do I sell puts? So that's some of the goals. And again, very often one way to trade, right? So you have a well-defined risk is using these spread structures, right? So I do like to trade spreads, right? We do trade spreads both for binary events like earnings, or if you want to, look at what can happen on Friday and basically trade at these support and resistance levels. So I'm basically showing you bear call vertical spread, right? If the market is overbought, if we're approaching 665, right? And you basically can say, well, Vlad, I think too far, too fast, 665. We need some kind of a digestion period. By tomorrow, we're not going to break 665. Okay, then what would be the structure of that trade? Once we approach in the 665 level, you can do a bearish call spread, right? And in this example, I basically structure a trade where my maximum gain is $24, right? So I'm getting 24 cents for the spread that's $1 wide, right? I'm selling 660 call. I did this example before the FOMC, before the Fed decision. So the overhead resistance was at 660. I kind of said the same thing. If you don't think Fed is gonna, deliver a positive surprise, basically reiterate what everybody expected in terms of number of rate cuts and the path of rate cuts. Then we will not break 660. Then you sell 660, 661 call, and you would get $24, right? And then I also explained that a lot of it depends on initial jobless claims today, right? If we have another 260,000 print, then market would most likely pull back. If we have under 250,000 or less than expected, I think it was close to 230,000, then the market could continue rallying, right? But in this event, if you did sell 660, 661 call, your maximum profit's $24, your maximum loss is $76. So you cannot lose more than $76. You cannot make $24. But $24 return divided by 76 in terms of, your maximum profit, it's 30% maximum profit, and probability of loss was only 30%. Again, model did not know about FOMC meeting. It did not know about or outcome of FOMC meeting. It did not know about outcome of initial claims. But trading those things alone, that would be the trade when we reach an overhead resistance, whether it's 660 that was there 2 days ago when I did this slide, or it's now 665. But the structure is the same, right? And we're trading, options that, short-dated options. right? You can do it, the options that expire, let's say tomorrow, Friday. There's option that expires Monday. There's options that expires next Friday, but that would be the structure of the trade. And it's a kind of a one way to know exactly what your maximum loss, exactly your maximum gain is, and learn quickly about the concept of time decay and probability of success, right? Looking at the delta and the correlation between the option price and the underlying stock price. And this is again versus bullish put spread, right? Where you would buy at the support. So, I guess if you were watching the market, right, and market either reached 655 yesterday during the press conference, Powell's press conference, right? It could be the same structure. You could sell a put spread, or this morning when we reach 660 level, you know that these are key supports because of the high concentration of open interest. And same thing could be done on QQQ or individual stocks like NVIDIA or Microsoft, anything that's liquid stocks that has a lot of open interest, then this same analysis applies, right? So when it reaches 660 level and you think, okay, this is a strong support and we're not going to break through the support, then you can execute bullish vertical spread, right? Same idea. In this example, I'm risking $23. Sorry, my maximum gain is $23. My maximum loss is $77. Similar structure, right? So I would sell 657 put. Actually, this example, that was exactly what happened yesterday. So you would sell 657 put, buy 656 put, right? You sell a more expensive option for 98 cents and you're buying less expensive options. And that is your maximum gain, right? Because it's a credit call spread. It's a credit put vertical spread. It's a bullish put vertical spread. So your maximum profit is $23. Your maximum loss is $77. Similar probability of, maximum profit is 30%, right? So, sorry, maximum profit is 30%, not probability. And probability, I mean, they kind of match, 30%, right? 30% that the 655 level would not hold, and as a result of FOMC meeting, we would continue to go in lower. Any questions on debit spreads? Credits. I mean, these are both credit spreads, right? But there is a bullish credit spread, there is a bearish credit spread, right? That you can structure taking advantage of the volatility, right? And the idea that this trade will not go outside of the range, right? If you think that volatility is going to expand, then these probably, then you would want to do debit strategies, kind of in similar structure.
Just one thing to add here for you, Vlad. One thing that some people may or may not have is this like probability of loss and probability of max loss calculation. If you're looking for something to just give you a quick proxy of it, that max profit percentage is easier to calculate, and that gives you a rough idea of the probability of loss in your scenario. So if you have a max profit of around 30%, basically the market is telling you that the probability of loss is 30%. So if you're looking for something that can give you a idea that, I think that there's a 30% chance that this scenario is going to come into effect, and this structure is saying that the probability of loss is 40%, then now I may have an edge over the market if my probability analysis versus the market's probability analysis disagrees.
Okay.
So yeah, I think that's a really fun tool and a good way for a lot of people. And the way I tend to try to look at it is if I think that there's a 25% chance of support being breached and the market's pricing in 35%, I may have an edge.
Thank you. Yeah, so this is a very important concept, and I encourage you to look at these trade setups, whether you trade in stock, right, or you trade in single options. Same idea, right? What is your maximum profit? What is your maximum loss? What is your probability of stock reaching those levels? And does it make sense to structure your trade where, you might, we're talking about sometimes people sell way out of the money options and you can collect maybe 5 cents, but your maximum loss is $1. Well, that means that, if you have one bad trade where you have a maximum loss, you have to, have 20 successful trades to break even, right? So you want to make sure that when you structure your trade, it makes sense in terms of what's your return on capital versus the risk you're taking, and it's justified. And also probability, right? Structure your trade where there's a high probability of reaching certain levels, right? Where you don't look for outsized moves without any catalysts. Again, just to reiterate, understanding that a lot of these models are built on statistics and current volatility, right? If VIX is at 14, 15, model works great. But as soon as VIX jumps above 20, well, the model needs to recalibrate. Doesn't matter if it's bar chart, yellow tunnel, any models, right? They would have to recalibrate based on a new volatility. Or if interest rates, right? There's a certain expectation of interest rates till the end of this year for the 26, 27. If the interest rate is going to start going higher or start going lower at faster pace, then the models will have to recalibrate, right? So when you're using these tools, always think about volatility and assumptions, right? And just if you're going to an event like yesterday, right, it's very hard to predict what would be the outcome of that FOMC meeting, right? People could have a positive reaction to kind of no new information, or they could have a negative reaction to the no new information, right? So it's important to understand that statistics is just that, right? It's distribution of possible outcomes, and you basically structure your trade based on these support and resistance levels and your opinion on direction, right? Short term, medium term, and long term. So we covered, kind of support and resistance level, very similar concept to last week, but last week we spent more time on technical analysis, kind of traditional chart patterns, traditional support and resistance levels. Now I'm putting a little bit more emphasis on looking at the options data and looking at the positioning, right? Futures or options positioning. All right. That's all I have for the presentation. I wanted to see if you guys have any questions. We can be more than happy to answer.
Yeah, thanks so much, Vlad, and thanks, Keith, for the input there. Vlad, if you just want to leave this slide up for a second, just so everyone can copy down your contact info. More often than not, with a ton of info in a webinar presentation, people will come up with questions after the fact, later this evening, tomorrow, next week. So if anyone has questions about this presentation, feel free to reach out directly to Vlad. He's got the phone number, email, everything right there. So please feel free to copy that down and reach out to him regarding specific webinar related questions. I am going to take control back just for a moment to remind everyone, if you are not already familiar with our website, avantgardetrading.com, you can also get here by typing trade AGT into your browser. Please visit us. Make sure you check out the education page. This is the page I'm showing you right now. We always post info on our upcoming educational webinars on this page. You can see Vlad's today right here. We'll give you a brief description, a big blue register for webinar button. Go ahead and sign up for our webinars, even if you're not sure you can attend live, because by signing up, you put yourself on the list to get the recorded replay. So definitely do that. Regarding our replays, we also include them on this page as well. So you can go back and watch them on our YouTube channel anytime that you'd like, but if you sign up for the webinar, you'll get them directly in your inbox. If you're not already on our webinar email list, I encourage you to enter your name and email, click submit, and get that done right now. Same deal. You'll get our emails about upcoming webinar invitations. That's going to come from info@tradeagt.com. The last thing I'll mention, if anyone does not already have an Avant-Garde brokerage trading account, I encourage you to take a look at our site. We have a special offer running through the end of the year. So you can open your trading account and receive commissions membership pricing for free through the end of the year. So definitely check that out. Visit our website at tradeagt.com. Give our team a call to answer any questions you might have, 312-858-5748. I want to thank everyone for taking the time out of their schedules, their lunch hours, to join us today for another segment of Lunchtime Options Trading. And thank you to Vlad and to Keith for taking the time to put together the presentation and chat with us this afternoon. We do appreciate it.
Thank you for the opportunity. Thank you, guys. And we'll see you next week.
It's been a pleasure. Sounds good. Have a good rest of your day, everyone, and good trading.